Welcome to InvestorHubX.com. Most traders have seen MACD before. Some traders buy when the lines cross. Some traders sell when the lines cross. Others simply ignore it because they think it looks confusing. But here's the interesting thing. MACD is much more than just a crossover indicator. It can help us understand momentum, trend direction, trend strength, and even warn us when a trend may be slowing down. In this video, we will cover: what is the MACD indicator? How to apply MACD on a chart? How MACD is traditionally used? Different strategies traders use with MACD. If you enjoy this video, don't forget to like and subscribe to the channel, as it helps us create many more high-quality educational videos. Let's get started. What is MACD indicator? MACD stands for Moving Average Convergence Divergence. It is a momentum indicator that helps traders understand the relationship between two moving averages. Basically, it consists of a faster moving average and a slower moving average interacting with each other. When these moving averages begin moving closer together or further apart, the MACD changes and provides signals that traders can analyze. MACD is commonly used to help confirm potential trend changes, trend continuation, momentum strength, potential buying and selling opportunities. Rather than predicting the future, MACD reacts to price action and helps us better understand what the market may be doing behind the scenes. So how do we apply MACD on the chart? First, head over to the Indicators section on TradingView, then type MACD into the search bar. Select the MACD indicator from the list. Once applied, the MACD indicator will appear at the bottom of your chart. By default, you will usually see the MACD line, the signal line, the histogram. The blue line is called the MACD line, the orange line is called the signal line. The green and red bars below are known as the histogram. By default, MACD uses the settings 12, 26, and 9. These numbers represent moving averages used in the calculation. The 12 represents the fast exponential moving average, also known as the fast EMA. The 26 represents the slow exponential moving average, also known as the slow EMA. The blue MACD line is created by subtracting the 26 EMA from the 12 EMA. The 9 is a moving average of the MACD line itself, which creates the signal line. When the blue MACD line crosses above the orange signal line, it is known as a bullish crossover, which may suggest that buying momentum is increasing. When the blue MACD line crosses below the orange signal line, it is known as a bearish crossover, which may suggest that selling pressure is increasing. Finally, the histogram simply shows the distance between the MACD line and the signal line. A larger histogram usually indicates stronger momentum, while a smaller histogram may suggest weakening momentum. The first traditional way trader uses the MACD indicator is called the MACD crossover. When the MACD line crosses over the signal line, it signals a potential trend change from a downtrend to an uptrend. On the other hand, when the MACD line crosses below the signal line, it signals a potential trend change from an uptrend to a downtrend. Strategy 2 is using the size of the histogram. In an uptrend, when the histogram bars begin increasing in size, it suggests that bullish momentum is strengthening. This may indicate that the current uptrend is continuing and buyers are gaining strength. However, when the histogram bars begin shrinking in size, it suggests that momentum is weakening. This does not necessarily mean the trend will immediately reverse, but it can act as an early warning sign that the trend may be slowing down or potentially changing direction. In a downtrend, when the histogram bars begin increasing in size below the zero line, it suggests that bearish momentum is strengthening. This may indicate that the current downtrend is continuing and sellers are gaining strength. However, when the histogram bars begin shrinking in size, it suggests that bearish momentum is weakening. Again, this does not necessarily mean the trend will immediately reverse, but it can act as an early warning sign that the downtrend may be slowing down or potentially changing direction. Before applying the MACD indicator, there is one very important thing you must understand. MACD is a lagging indicator. This means MACD cannot predict future outcomes. Instead, it reacts to price action and helps confirm trends. To increase the probability of our trades, one strategy traders commonly use is combining MACD with divergence. So what does divergence tell us in price action? Let's take bearish divergence as an example. A bearish divergence occurs when price makes a higher high, but the MACD creates a lower high. This suggests that momentum may be weakening even though price is still moving higher. It can act as an early warning sign of a potential trend reversal or a possible short trade setup. Here we have Bitcoin on the weekly time frame. We can see that Bitcoin makes a higher high on price. However, the MACD forms a lower high. This creates a bearish divergence. What follows afterward is a trend change from an uptrend into a downtrend. Now let's look at the opposite example. Bullish divergence. A bullish divergence occurs when price makes a lower low, but the MACD creates a higher low. This suggests that selling momentum may be weakening, even though price is still moving lower. This can act as an early warning sign of a potential trend reversal or a possible long trade setup. But remember, divergence should not be used alone. It works best when combined with support and resistance, trend lines, volume, and price action confirmation. If you find this helpful, please visit InvestorHubX.com for more lessons just like this. We are building a complete learning platform designed to help investors like you master technical analysis, stocks, cryptocurrency, commodities, precious metals, property investing, and more, step by step. You will also get access to custom indicators and in-depth video courses to support your learning journey and take your skills to the next level. To summarize, in this video we learned what the MACD indicator is and how it works. We learned how to apply MACD to a chart and understand its different components. We also explored the traditional ways traders use MACD, including MACD crossovers and histogram analysis. Finally, we learned how MACD divergence can be used to help increase the probability of trade setups. Remember, MACD is a lagging indicator. It does not predict the future, but it can help traders understand momentum and confirm potential market movements. If you found this lesson helpful, please give the video a thumbs up, subscribe to the channel, and turn on notifications for future lessons. I'll see you in the next video.